Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And the new game we've been playing in the month of February, which is how badly can U.S. economic data spook financial markets, is entering its next inning. We begin a new week. There's another set of U.S. economic data on the calendar, and everybody can prepare to clutch their pearls. So let's go ahead and take a look at what we have on the docket for this week. Obviously, the main story here continues to be the extent to which the Fed is going to keep raising rates higher and holding them there for longer. And so that is the lens that we are going to be looking at. And of course, that has been a critical narrative, not just for U.S. stocks, not just for the dollar. That has been the abiding narrative really across the range of global markets and the entire asset spectrum pretty much writ large, with very, very few exceptions, certainly not anything immediately liquid. So with that in mind, we are going to look at those pieces first of U.S. economic data that can shape this picture. And as we work here through the course of the week, there are a couple of items off the U.S. calendar that might be of interest. We'll look at those as they present themselves. Here is the set of key numbers for the week. You can see there's some Australian items here, some German and Eurozone ones, a Canadian GDP report for tomorrow. But the key pieces that really shape this narrative are probably going to again come from the U.S. because really this is a Fed story. We've talked, of course, about why this is so concentrated, so focused just on the Fed. And that's, of course, the ubiquity of the U.S. dollar as the global medium of exchange, as the quintessential lubricant for commercial activity, basically for the entire globe, unless you are North Korea and increasingly Russia, and therefore cut off from the global economy, cut off from global supply chains. So those things aside, those exceptions aside, the world is largely dollarized in terms of commercial activity. According to the Bank of International Settlements, over 80% of global monetary transactions are ultimately settled in USD. What that means is that when the Fed increases the cost of borrowing dollars, obviously with an eye on the domestic situation, it also increases the cost of borrowing everywhere and for everything, because almost everything is settled in dollars ultimately, be it commodities, be it key financial assets, key inputs into economic activity and so forth. And so with that in mind, it is U.S. economic data and the Fed that we are so focused on. Because before we get into regional differentiation, sector differentiation, we first have to resolve what is the cost of money? What is even the cost of taking an investment or some sort of market risk allocation, or even a purchase that might need financing or might be large enough that financing for something else might become necessary because capital has been tied up. This works at the household level just as well as it does at the corporate level or at the sovereign level. At the household level, it's, do I want to finance a car, or do I want to buy an expensive piece of furniture? Thereby, I pull down my cash reserves, and if I then need to buy a new car and finance it, I have less to work with and need to finance more at prohibitively higher rates. Even those kinds of decisions are inextricably linked here to what the Fed is going to do and the extent to which they're going to do it. So the numbers we're going to look at here are those that might shape this narrative, at least that might have the markets speculating that they might shape this narrative. First, we have a consumer confidence number from the conference board. Then we have the key ISM business activity surveys. We're going to have the manufacturing one for February 1st. You can see the expectation there is we're going to go from 47.4 to 48, as ever in the logic of PMIs. That's contraction, but at a slower rate. And then we're going to have services later in the week. You can see there we're going from 55.2 to 54.5, so growth, but at a slower rate. Again, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the pace of growth. The further you go below 50, the faster the pace of contraction, and of course, vice versa. So let's unpick this one by one. We begin with consumer confidence. Here we're looking for a slight uptick. So you can see the previous number there, 107.1. The expectation here is 108.5. So nothing incredibly dramatic, still within the realm of recent releases, but a little bit better. And we can see from looking at the analogous University of Michigan Consumer Confidence survey. The previous one that is coming out this week is from the conference board. This one's from the University of Michigan. You can see this one has been somewhat improving since the middle of last year or so. And that has been consistent with a pickup in U.S. economic activity over the same period of time, and also with a pullback in inflation over the same period of time. And so this is the Fed's efforts sort of showing up in what consumers observe in terms of the price tags they encounter. Inflation has been easing. It's certainly not back to target. It's certainly still uncomfortably high, in particular in services. We know the Fed has been focused on services ex housing as kind of its main area where it looks to see if it's doing a good job in containing growth in prices. This, of course, makes sense. This is where wages, the stickiest domestic element here, are the most critical of a factor. And so as we look at this, we can see there's a good chance, seemingly, if the University of Michigan analog here holds, that we see something similar here. We continue to improve here, again, along the same grounds and on the same logical underpinnings, that inflation has eased some. We can see that occurring on the good side of things. Consumers, needless to say, get a bit of a reprieve then as relative to the middle of last year. And so you might get a little bit of a pickup in confidence. In the logic that we're deploying here, that's not good news for equities, unless the number is so wildly strong, as unlikely as that would be, as to somehow throw the Fed calculus off course. But the message that we've increasingly seen in markets has been, if U.S. economic data is better, that means the Fed will have to raise rates higher and hold them there longer. And these markets clearly have been focused much more on liquidity than the business cycle, which essentially means if you make credit more expensive, the markets are unhappy. And so to the extent that we get a little bit of a green shoot, a little bit of an improvement in consumer confidence on this measure here, and to the extent that it follows the lead from this University of Michigan survey, you end up with something that looks like a U.S. economy that might withstand a little bit more tightening, which of course is not, on the face of it and in line with recent dynamics, not good news for shares, not good news for risk assets, maybe better news for yields and the U.S. dollar. In some ways, though, this is a relatively minor release, and as long as it prints reasonably in line with expectations and doesn't shock one way or another, the markets may get a little bit of a license to consolidate and to digest some of their recent risk-off moves. We saw a similar sort of dynamic today where we got durable goods orders data that was relatively mixed, but at the very least did not move the Fed story forward. Didn't move it back either, but didn't move it forward. And so there was a little bit of a pause in liquidation. So perhaps this is a minor enough release that something like that could occur here as well, as long as there's not a dramatic surprise one way or another. Really, the main story, though, this week will be those ISM surveys. And what I've done here is I've unpicked a little bit, first the manufacturing and then the service sector. Let's look at manufacturing to begin with. The yellow bars that you see in the back there are the overall index. You can see that the expectation, that's that lone green bar at the end, is for a bit of an improvement. So we're expecting to go up to 48. So we're going to shrink still in the manufacturing sector, but at a slower rate. The really interesting part here, though, are the underlying components. And what I've looked at is what seems to be the least lagged component, new orders, and then the most lagged component, employment. You can see employment has been essentially steady for nearly 3 years now. Let's call it 2.5, just to keep it very, very honest. So you can see here it's been essentially oscillating right around 50. So we've had a modest, steady state for employment. Sometimes we get a little bit less, sometimes we get a little bit more, but it seems like the average, that flat lining of the dark blue line there, marked at 50.6, basically gives us steady employment at a time when new orders are falling, as is the overall index. So you can see demand here withering. And you can see that's pulling down the overall index. But you see inflation probably stickier because that employment component is steady. And so that element that the Fed is most concerned about, wages, is holding up. And that is exactly the kind of logic that might encourage them to continue. So when we look at this, it might be less about the headline number and more about what's going on at that employment component. If at the same time we also get a bit of an uptick in new orders with the recent analog PMI numbers out of S&P Global, that's not by any means an out there bit of speculation. Those numbers have been increasingly better for the past several months, and they run a little bit ahead of this release. So we already got those numbers for the same reporting period last week. They were better. So looking at this now, similar story. If we get a little bit better on the overall index, if we get a little bit better on the more fast-acting, more reactive elements in this index, like new orders, and employment doesn't appear significantly hampered, well, then we're looking at a Fed that has something of a green light, it would seem. Let's look at services. Things have been a little bit more buoyant here. We had a really robust pickup in new orders, back over 60 there. You can see employment, very similar story. On the overall index, which again is those yellow bars in the back, you can see we're looking to come in just a little bit, slightly slower rate of expansion expected at 54.5. The employment number looking almost identical to what we see in manufacturing, slow sideways drift. So the main takeaway here, whether you look at manufacturing where the demand side looks weak, or you look at services where the demand side looks strong, the employment picture looks pretty much identical in both. And that's what the Fed is up against. As long as that continues to be the case, We are unlikely to get a Fed that changes its mind in any kind of hurry. Consider where we began this entire February readjustment. This is the latest set of employment figures. That 517 there was more than double the expected increase in non-farm payrolls, and that 3.4 unemployment rate is the lowest in 40, 50 years at best. And so this now is still very much the story of a labor market that's showing enough resilience that wages might be sticky. Sticky wages, of course, mean sticky input costs, labor costs, for pretty much every stripe of economic activity you can imagine, certainly strongest at the service side of things where most U.S. employment lives. The service sector is about 75% of the overall U.S. economy, much more so than manufacturing. And so you have a situation then where you still have enough of a concern that you're going to bake in these costs. Employment contracts, of course, are not signed and then readjusted when inflation cools. It's one of those things that tend to get locked in. The more of these employment contracts that you lock in at these elevated levels, the longer it takes to topple the labor market with this Fed tightening, the more ostensibly the Fed needs to signal it's willing to do and then ultimately do to get inflation from getting embedded into the overall cost structure for every which thing in the economy. You can see, interestingly, that the price component of the service sector PCE seems to, in fact, be easing. At the very least, this is what we saw in the previous month's survey. You can see the top there seems to be coinciding with about a 2-month lag in a top in core personal consumption expenditure measure of inflation. That, of course, the Fed's favored. The market tends to look at CPI because that's something that's generally transferable from one economy to another. Almost everybody uses a version of CPI. The PCE one, though, is the more Fed-favored measure, and the core PCE is really what the Fed looks at most closely as the underlying trajectory for where inflation's going. You can see that with about a 2-month lag, the pricing component of service sector ISM anticipates the turns in the PCE index. So that would suggest perhaps we've topped, at least on the inflation side of things. But of course, this is monthly data. So there is a lag. If we look at how that's instead looking up stacked against priced in expectations in the bond market, which move in real time, we can see that there's also about a 2-month lag between where the break-even rate at the 2-year tenor is. That's the difference between nominal and inflation-adjusted bond yields over a 2-year window. And of course, when you take that difference, you get that inflation adjustment from nominal and to the real rate extracted. So you can get the real kind of bond market inflation expectation in looking at it. You can see for February, we're well north of 3%. We've been rebounding. And indeed, you can see that the turn in those expectations anticipated a turn in the PCE and some stabilizing in CPI that we've seen in the most recent data. That suggests that the relationship holds, and we'll be anticipating a further upturn in inflation numbers over the coming months. That means that whatever we might see here on the ISM numbers could actually give us a bit of a pickup in that underlying indicator, suggesting that as long as there's consistency, we have the case for a Fed that needs to do, once again, more, and markets that need to bake that in further. Here's how the curve has looked in its evolution this month. Obviously, we began this whole readjustment in markets with the Fed's February 1 policy announcement, and then with that NFP release just 48 hours later. Look at where we are in this yield curve. It is quite the dramatic shift. So you can see that as of the end of last month, we had a peak in rates that was perhaps occurring around the same time it's occurring now. So 6 months forward, at the end of January, that was, let's call it August-ish. It's still about August-ish, but of course now later. There is no policy announcement in August, actually. There is one in July, and there's one in September. So we're still kind of in that window of the peak in rates is going to happen somewhere in between those two announcements. Either it'll be earlier in July or a little bit later in September. We seem to be veering toward September here increasingly. And you can see that the structure, whereas before it was looking at a peak sub 5%, we are now well north of that. We are at almost 5.5, 5.46 here 6 months out for the peak in rates. We can also see that 1 year out, we are still north of 5%. That is quite the change. So we are now basically saying that a year from today, so going into March of 2024, we are still looking at rates north of 5%, having not expected them to even get there a month ago. And so this is a really dramatic shift in what the markets are anticipating. You can see there's also been a very clear shift at the longer end of the curve. The 2-year, the 3-year, now starting to get a little bit closer to 4 and 3.5%. So what is the longer term floor on rates is shifting higher. And that's really important because, of course, it suggests that anybody that's out there, a business that's maybe looking to expand, maybe looking to add some investments into more capacity, a fund or a big asset manager looking to deploy capital on the risk side of the spectrum, even perhaps someone looking to finance a purchase of a new car or a new house or a new dishwasher in a year's time is looking at this and saying, I'm going to have to finance at a higher cost. Or at the very least, if I buy something now, I'm going to have to roll it over at a higher cost. And so with that in mind, maybe I'm just not going to do it. Maybe I'm just not going to commit to any kind of significant expense now. Because at the very least, even if I don't expect to take out credit, if something should occur that I do, it'll be at a higher rate than I thought was going to happen even 2 weeks ago, never mind a month. If we look then at what this repricing has looked like, this is a curve that's less anchored in time and more anchored to actual Fed policy announcements. The orange line there, September, you can see the peak at 5.42. The July there, 5.41. So basically the same story as you would see over here, though, of course, this is more in terms of time. This is more in terms of actual Fed policy announcements. So you can see we're looking now at a move in markets that's been clearly catalyzed by these two lines hopping out of their November to or through January into February range. The markets thought they had it figured out. They thought they had stasis. Clearly, the data has shown them otherwise. So if you look at what that now looks like as far as the expectations are laid out into the beginning of next year, you can see one rate hike for March fully baked in at this point, and indeed a slight possibility that we might get a bit more, about a 20-21% chance of a 50 basis point rate hike there. You can see that by looking at the percent hike cut column. You can see 120 in there. That's 120% of a 25 basis point hike. You can see the next column over implied rate delta. That's 30. So that's a little bit more than 25. That gives you that 20% extra chance. If you look at where we are for May, 100% of a 25 basis point hike baked in, but again, we don't see 50, we see 57. So an 8, give or take 9, if we round it up, chance of a 50 basis point hike there. So very, very slight. It looks like we're going to get almost certainly the full 50 basis points between May and March. By the time we get to June, we've priced in a third rate hike. 75 basis points is already in there. We see a little bit of a drift then. We sort of edge a little bit in the middle of that range. So 83, 79, these are not full hike moves. And so it seems like we're essentially kind of moving around in this range there, where we're going to sort of hover in the 5.25 to 5.5 area. You can see the implied rate column tops at 5.4. So a little bit closer to 5.5, but still in that target range. And we still, it looks like, by January of next year, see the Fed taking away one of those hikes. So you can see come the meeting at the end of January of next year, we're at 5.17. So in other words, we've gone back somewhere between December and January and said, we're going to go from 5.25 to 5.5 to 5 to 5.25. So in other words, we're going to give away one of these hikes. This now seems to be where the most reactivity for this market is. So if we can take that cut away, if we can put that out of range for near-term market expectations, that's a further adjustment that can still occur. The markets are still toying with this idea that the Fed is going to retreat by the beginning of next year. If that fundamental assumption goes away, we might be looking at a much more defensive state in markets, and we can see what the upshot has been. Since the beginning of this month, dollars up about 4%, S&P down close to 4%, gold, which yields nothing and therefore looks awful in an environment where both rates and the dollar, thanks to the rates, are going up, gold is down 6%. So the logic that you might find in these ISM numbers, as long as they don't come in so soft as to make the markets rethink the Fed entirely, the path of least resistance seems to be more of what you see on the screen here. Now, of course, things don't move in straight lines. There's, of course, going to be ebb and flow along the way, but it seems really difficult in this current environment to dislodge this narrative without some kind of really substantive change in these numbers that would alter the Fed's calculus, at least in the minds of investors. And there doesn't seem to be anything immediately on the menu to do that, looking at the way that the landscape is laid out. With that in mind, this has been Macro Money. I am Ilya Spivak, head of global macro for Tasty Live. We're here 4 days a week, Monday through Thursday, right after overtime with our friend Chris Vecchio, head of futures and forex here at Tasty Live. Outside of that, you can follow my various musings on markets via Twitter at Ilya Spivak. Thanks very much, everybody. Good luck this week. Godspeed. We'll see you.